There's, as we said, plethora of information that one needs to digest. I think the most important that has been happening over the last few sessions, apart from the local news, we have been seeing Deutsche Bank, a lot of reports that perhaps this bank is going to go to the markets to try and raise around 9 billion euros. Systemic worries still filtering through for the banking sector in the European Union. What does this do to one's investment strategy here in South Africa when there's so many risks in the developed world?
I think with all South Africans, we should have the majority of our money where our liabilities lie. So your assets and your liabilities should be pretty much matched up. And according to the law, we're only allowed to have 20% offshore, and I wouldn't exceed that. I think it's good to have some diversification away from South Africa, which is effectively exposure to other currencies. But I think even though we do have that cash offshore, we should be careful where we put it. And I think we're going to keep on seeing more banks coming to the market for greater capital. I was reading an article this morning which suggested that the Germans in particular are trying to get the Basel Accord, the new rules, postponed to later in the year, or perhaps even at the end of next year, which would alleviate some of the funding pressures that banks are finding right now. But with everything as it is, we're going to keep on seeing banks coming to the market for more capital.
Well, you know, Kimon, when you see what is happening in the European Union, and I like quoting Clem Santa here, he is an advocate of putting all your eggs in one basket, and that, of course, being South Africa. And he is saying that if you do invest in the EU or in Japan or in the US, you are likely to lose money because of all the systemic risks that still have not filtered through in the economy. You're saying that perhaps having 30% offshore, where would you be putting your money right now? Because I think many people are still skeptical about the Eurozone.
No, what I was saying was up to 20%, which is what we legally allowed to have offshore. What I would do is I'd look for conservative investments, and really it's purely for diversification purposes. And I don't agree with having all your eggs in one basket anyway, because that's like owning one share in your entire portfolio or one particular instrument. So I do believe in diversification, but I think once you diversify too far across the board, you get mediocre returns. And what we really should be looking at is in terms of the asset classes. And the big asset classes are obviously equities, bonds, cash. I would diversify further into looking at other instruments like inflation-linked bonds and the 20% offshore currency exposure, etc. Yeah. But I wouldn't go more than that 20%. I think it is good to be diversified. And where I would be looking would be countries that look like they've got some kind of recovery possible. We've got a strong correlation between ourselves, Canada and Australia. So I wouldn't go necessarily invest in those countries. I'd rather have the money here in South Africa because the correlations are so high. So in terms of diversification, I'd be looking for other interesting places which offer high levels of growth, maybe even India, possibly Brazil to a certain extent, and certainly China.
Kimon, we were talking ETFs a little earlier. I don't know if you caught any of that interview, but it is an interesting thing that is playing out globally, $1 trillion, and that's what the ETF market is worth right now. We're seeing many people coming up with new ETFs, even here in South Africa, many banks even launching various ETFs. What is your view on ETFs? Do you have that offering at Trident Capital?
No, we don't. But ETFs have their place. But remember, they're just derivatives of the underlying asset classes. So you'll find an ETF that perhaps has got equity exposure, they're geared. I think you've got to read the fine print when it comes to ETFs. They're not for the faint-hearted. I do think there is a place for them. For example, gold ETFs give the man in the street access to owning bullion directly. So what I would look to do is look at the institution that stands behind those ETFs as a guarantee. So not all ETFs are created equally.
Kimon, bonds, you were talking about inflation-linked bonds, looking at the equity markets. One only has to hear the verbiage from South African Reserve Bank Governor Jill Marcus about how many funds and flows we've been seeing into the bond market. Do you think that is likely to continue? Don't you think that perhaps we're starting to see things heating a bit too much in the bond markets, and that could result in a lot of people getting disappointed down the line?
Possibly. I do think we are reaching a level which I don't think the kind of flows that we've seen will be repeated going into the future. I think you get to a level of return where foreign investors will say, for any other kind of risk, it's perhaps better to have other diversified bond holdings. But currently what we are finding is that the international investors are probably more of a longer term nature type holders of South African bonds than they have been in the past, purely because of the yield differential between ourselves and offshore. Also, with inflation coming down a little faster than anticipated, it gives them a greater level of comfort holding South African bonds, and possibly they could be holding them for that little bit longer.
Interest rates in South Africa down 50 basis points. It's pretty much what most people had expected. Your view on this, and how would you be changing your investment strategy going forward, if at all? Because it is interesting. You mentioned the inflation outlook looking slightly better going forward. Jill Marcus alluding to the fact that we will not be seeing a move to the upside on the interest rate for at least until 2012. So, I mean, a lot of interesting notions that came through on that front and could change your perceptions about which stocks to enter into.
I don't think I'd be changing anything right now. We've had a view that you should be diversified, should have a decent bond holding. It's followed through. We've seen those interest rate cuts. The bond market has been one of the best performing markets year to date. I think it's the second best performing asset class, in fact, next to inflation-linked bonds. I wouldn't change any kind of strategy dramatically, but if there were a further strengthening, I'd possibly look to sell a few bonds on the margin, really, and keep equity holdings as they currently are. We're very happy. I don't think anyone should be holding more than 50% of a portfolio in equities. Certainly the inflation-linked bonds have been very aggressive, and they've had wonderful returns. I think in year to date, we've probably returned 14.5%, close to 15% in inflation-linked bonds. And I don't think one's portfolio should consist of less than 10% of that particular asset class.